Welcome to Willis Weighs In, where we discuss controversial and newsworthy tax planning topics. My name is Ben Willis, contributing editor with Tax Notes. Today, I'm here with Comisky to talk about the Corporate Transparency Act of 2020. Ian is a partner at Fox Rothschild, and he has more than 35 years of experience in tax controversy. Ian, thank you so much for joining us today. How are you?
I'm fine. Thank you for having me.
Great. So we're here to talk about the Corporate Transparency Act. Could you start off by telling us a little bit about it?
Yes, this piece of legislation, for the practitioners, came literally out of left field. It was an act which was vetoed by Congress at the end of last year for a defense authorization bill, and stuffed into the bill was 75 pages of money laundering amendments. So the prior president, the only time in his administration that he vetoed something, this was passed over the veto. And in this bill, this defense authorization bill, Title 14, there's other titles, which we're not going to cover today, deal with money laundering. Title 14 dealt with establishing beneficial ownership information reporting requirements, the Corporate Transparency Act. And this doesn't always happen, but Congress wrote a sense of Congress provision, which is what it sounds like. It's the sense of Congress about why this was needed. Why it was really needed, before I read the sense of Congress, was that the U.S. had been criticized for years and years as really being a tax haven and a money laundering haven, because there was no control over the corporate organizations and registries in each state, and there was no central way to really determine beneficial ownership information. We'll talk about a little bit what the banks were doing, but there was nothing at the state level, and there was nothing at the federal level. And the U.S. for years and years and years was used as a haven because of that, especially by an outfit called the Financial Action Task Force, which acts as a money laundering advisory policy board in Europe. And any event, so they crafted the sense of Congress provision and noted there were more than 2 million corporations being formed each year. I assume they had research on the number. They noted that most of the states don't require information about beneficial owners, which is absolutely correct. Right now I could go in and form a corporation, and somebody could do it for me, or somebody can act as the incorporator, and you can never figure out whether it's 1 layer down, 2 layers down, 3 layers down before you get to the real owners of that entity. They wrote that, quote, malign actors seek to conceal their ownership of corporations in the United States for money laundering, financing of terrorism, proliferation financing, services tax fraud, human drug trafficking, the usual litany, but they wrote all of it out. Counterfeiting, piracy, securities fraud, financial fraud, and acts of foreign corruption harming the national security interests of the United States. They put in a paragraph about money launderers and others involved in commercial activity, conduct transactions in these structures, and they actually cited the Russian nesting dolls as an example. I don't know if the audience has ever seen that, where you open the doll up and there's another little doll, and you open the next doll up and there's another little doll. They get smaller and smaller and smaller and smaller till you get to the last doll, which almost disappears. And that's what they were alluding to. And then they go to federal legislation providing for beneficial ownerships needed to set a clear federal standard, protect vital U.S. interests, protect foreign commerce, protect national security intelligence, and last but not least, bring the U.S. into compliance with international anti-money laundering and countering the financing of terrorism standards. And then it goes on from there. But there was heavy criticism. They weren't getting anywhere with getting states to do anything. A national policy was needed. But the real guts of this was the concern that foreigners were controlling U.S. corporations, and you couldn't figure out who was really owning the foreigners, participating in the U.S. corporations. But they didn't just regulate that; they regulated every corporate formation in the United States. And you'll see there's a look back, which requires existing corporations within 2 years of regulations coming to existence to then go back, existing corporations, and go up and register. So they created a new provision in Title 31. Title 26 for the audience deals with taxes. Title 31 deals with financial crimes. And this Money Laundering Act had all sorts of Title 31 amendments. But in any event, it creates a beneficial ownership registry. for the first time in the United States. And it's going to be required anytime an applicant files a Form 4. This covers corporations, limited liability companies, or, quote, similar entities. And that's one of the open issues and wild cards about what a similar entity is going to be defined to be, and registers or files an application under the laws of a foreign country to do business in the United States. And that's another open issue about if you don't have to register to do business in the U.S., should you be regulated anyway. And the beneficial ownership definition is with respect to, again, an entity, an individual who directly or indirectly exercises substantial control, that's a term of art, or owns or controls not less than 25%. Now, there's an existing framework for some of this stuff already. It's called the CDD, Corporate Due Diligence, which for some of you who have some knowledge of the background, know your customer rules for banks. And that's got a slightly different definition. So one of the issues is this deals obviously with ownership, pure ownership. And the corporate due diligence rule has a separate prong for people who are in effect running the corporation. So some of the comments, there's 400 plus comments in on this already, have asked that, are you going to harmonize this set of rules with the customer due diligence rules? And there's actually a third set of rules we don't have time to go through today with foreign bank account reporting, something called FACTA, which has yet another different set. And you're really going to have three different sets of rules on what's got to be reported for beneficial ownership, or you're going to try to harmonize some of it. But the basics are the real beneficial owner is going to have to register, and if you don't register, it's a felony. So they made up sort of a funny felony. It's a 2-year. You could argue it's like an extra misdemeanor, because it's a 2-year crime, not a 3 or a 5-year crime. But it's got a significant criminal penalty if you don't comply with this framework. And the framework then goes on and has, there's a whole slew of exceptions, such as for public accounting firms. So as you can imagine, the smaller accounting firms that aren't public, they want to be exempted too. So there's letters coming in on that. This isn't effective again until the regulations come out. They have to come out by the end of the year. I did a program with some FinCEN representatives not too long ago, and I asked them as a matter of courtesy, just don't issue the regs at Christmas. Give us all a break. Either issue them beginning of December or issue them, after the new year, except they can't issue them after the new year, they have to issue them before, but give us a break and don't issue them between Christmas and New Year, to make us read, who knows what will be 100 or 200 pages of regulations over Christmas break. So we'll see how that goes. But they got exemptions, including for public accounting firms, there's insurance companies, and there's plenty of other exemptions. And there's a couple exemptions actually of interest. There's an exemption for an entity that employs more than 20 employees in the United States full-time, filed tax returns with more than $5 million in gross receipts, a fairly high number, and has a physical operating office in the U.S. So if you have more than 20 employees or $5 million in gross receipts, and you're physically in the U.S., you'll be out of this reporting regime. Otherwise, you're in the reporting regime. There is an exemption also for inactive corporations, which are really doing nothing, but everybody else is in. Everybody else is going to be in this, and Congress was worried about confidentiality of information. It's not like we haven't heard in the papers about some leakage of tax returns, as recently as the last couple of weeks. They put in a whole regime to try to keep the information confidential. So the information is not subject to automatic disclosure. Requests have to be made, and protocols have to be issued when you're making the requests, whether it's by a bank or law enforcement agencies, and they don't define law enforcement, probably something else they have to define. And state and local governments, you have to get a court order. That's going to have to be defined who they can do it. And you go all the way back to the beginning. The reason for this, in part, the commissioner of the IRS was speaking a number of times earlier this year. And he's now estimating there's $1 trillion tax gaps. So you're dealing not just with money laundering. You got $1 trillion gap. You can't figure out who owns, perhaps a corporation. The individual files a U.S. return. You don't know if he's related to a corporation. If this information is in fact made available, it would help auditors tremendously, IRS revenue agents. They'd be able to say, sir, you registered with the FinCEN registry for 3 corporations, but I don't see anything on your tax return. So the response would either be, I didn't earn any income, or, they found out, or something in between. But that's probably what's going to, happen in the future. And just having the information available can be used for data mining, and the like. But it's interesting, they actually made the disclosure improperly of the information a 5-year felony. It's only 2 years in jail for not registering. That shows you how much Congress is really concerned about the leakage of information, which, look, happily it's Washington. We'll see if it occurs anyway and what kind of protocols they put in to stop it.
So I can't help, you and I both do tax, so we're visual, and I've got these nesting dolls in my head, and boy, I mean, come on, nesting dolls are cute, right? Like you stack them on top of each other, but we got this statement by Congress effectively saying, hey, we're looking for these malign actors who, are committing these somewhat heinous crimes that you described, depending on what the focus is. But yet it seems like this legislation covers so much more than just that. And the fact that you potentially are subject to 2 years in prison for not reporting to this massive FinCEN database that's now going to be tracking all this information and beneficial ownership, it makes me wonder whether or not that whole history of wanting to capture these malign actors who are hiding through these nesting doll scenarios, layers and layers and layers of complex structures to hide, secret, businesses that are being conducted throughout the world. Are you by default a malign actor by failing a reporting requirement? It almost seems to be the case, but I'm just curious as your thoughts on that.
Hey, look, one could take the position. This isn't a political discussion. This is that they what's the term? They kill the fly with a small atomic weapon. One might take that position, and maybe they'll limit some of this with regulations. But it's you're right, it's very, very, very broad. And under the rubric that they were going to catch, money launderers and narco terrorists and the like, they've regulated everybody. So if I go in and form a small corporation tomorrow, I got to register. And again, it's not supposed to be available to everybody, but here's what's going to happen. The early comments, from this April 5, set of questions, a bunch of them are from financial institutions. And what's the first thing they're saying? We don't want to have to do our customer due diligence anymore. This is going to save us a lot of time, FinCEN. What you should do, FinCEN, is verify all the information coming in. So you can root out, the people who are lying and charge them before the FinCEN identifiers are issued. And therefore, we at the banks can save money for ourselves, and we can just rely on what FinCEN has done. And what's going to happen is, if you go to a bank 3 years from now, pretty good guess, you're going to have in your application form to open a corporate account a waiver of confidentiality. There'll be a privacy waiver for this, or you won't be able to open an account. And the banks probably can do it. So you go into the bank and they'll say, we want you to waive your FinCEN privacy. And you'll go, why do I have to waive my FinCEN privacy? And they'll go, do you want to open an account? Or do you not want to open an account? And what is going to happen is, I think this is more than likely because in the foreign bank account regime, all the foreign banks have done this. They put in provisions in their customer agreement that we have to comply with the U.S. regulatory regime. FACTA, you consent to that by opening the account. It's going to be the same thing. I can't see the banks doing any different. The question is whether FinCEN's going to do any verification. Whether if you put John Doe on the form as the beneficial owner, FinCEN's just going to accept that, or they're going to do something with it to see if John Doe is really the owner. It's probably going to be the latter. I don't think they're going to take all the responsibilities away from the banks, but what they will do is there'll be, in a sense, an automatic turnover of this identifying information, to your local bank and you'll have to keep it up to date, or the bank will close your account. That's going to be the real interim. It won't be the 2-year felony. It'll be you won't be able to get banked in the United States if you're not complying with this regime. That's what I see happening. Treasury has 48 questions here. For instance, they can make it even broader. They can make it narrower. They can make it broader. What's a similar office? A document with a similar office as opposed to a state or federal corporate document, corporation office. For instance, are they going to pick up non-depository trust accounts? If you form a trust account for a child and you open a bank account with it, you don't have to file that with the state. You don't have to do anything with the state. But if you're truly trying to see beneficial ownership, you can define that as a similar office, because you eventually file a tax return for the trust, and you have to file a trust document somewhere, and you can make the thing even broader. Then there's questions about what information should you provide, again, for trust vehicles. What information should you provide for exemptions? This thing goes on for, triple columned for multiple pages of just what they have to think through between now and the end of the year. How they're going to deal with ownership and control. How they're going to deal with, exemptions. How they're going to deal with what happens if you don't file timely. There's a safe harbor. How are you going to define the safe harbor? Who should have access? What kind of identifier are they going to use? For instance, you got to get how many digits you got to have for the identifier. Is it going to be something which will be easier for a bank to use? If you're not complying, how are you going to get notice so you can get back into the safe harbor?
Give me a description of a similar entity, if that's possible.
A non-depository trust.
Okay.
Banks right now, the U.S. regime, they've been subject to a lot of criticism. The domestic regime, if you form an account for a trust, the person who's got to report for customer due diligence now, you list the trustee, you don't list the beneficial owners. And I have seen charts where a trust owns a series of corporations. Those corporations own another series of corporations. Those corporations own another series of corporations. If the trustee is the person you have to contact, you don't get anywhere. You really don't know who's running the company, who really is the owner. You give me who's running it, but you don't know who the real beneficial owner is. And if you're going to start drilling down on trust and beneficial owners, that's a game changer. That's an absolute game changer. Some of the foreign regime for FATCA requires that. How effective it is, who knows? In theory, the IRS can be doing audits on that, but I haven't seen anything. This will be domestic, and it'll be easier to regulate and easier to take a look at. But if they start getting to the real beneficial owners of the trust, which could be, the forms of trust for the benefit of, say XY, trust for XYZ Corp, or corporation owned by a trust. Do it the other way. Corporation owned by a trust. Who in fact is the beneficial owner of the trust? How many layers do you have to get down below that trust to figure out who really owns it? Now they're going to have to list it. And if they don't list it, they're going to have trouble getting banked. If they list it falsely, it's going to be a crime. If they list it accurately, that information is going to be out there for law enforcement. Look, there's always a way. I've been practicing long enough. There's always a way, to conceal something. This isn't a how-to, ladies and gentlemen. There's always a way to conceal something. But this is going to be a game changer in being able to drill down and requiring real information. So you can stop, if something illegal or improper is occurring with the accounts and the entity number one, and more importantly, something as simple as taxes. Are taxes getting reported where you didn't have this kind of information before? It looks like you're going to be able to get it now, even though it's not entirely clear that law enforcement, which is the definition, would include an IRS civil revenue agent. They're going to have to probably clean that up by regulation, because that's not crystal clear either. Criminal IRS, yeah, that's law enforcement. But a civil agent who's doing an audit, is he or she going to be able to get access to this? That's an open question as well, which all remains to be seen. So for the practitioner, we're going to have plenty to do at the end of the year. We're going to have plenty to do beginning of next year. Banks are going to have plenty to do, because what happens with this, part of this regime is they're going to redo the customer due diligence rules for the banks. There's going to be a whole separate set of regs that people can comment on. depending on how they structure this, to how the customer due diligence gets changed or not changed or updated, or how it's going to work in an interplay with the Corporate Transparency Act. And if that's not enough, the Act provides for a study group with the GAO to look about regulating partnerships. And you can't promise anything in our business when you do tax controversy, but I can just about promise you they will regulate partnerships in the same way as soon as the GAO study is done. So you have corporations for the first time subject to a registry. Partnerships may be subject to a registry. It may include non-depository trusts. It's going to be available to your local bank, I think, or you're not going to be able to bank. And it's going to be fodder for audits, probably, and certainly criminal investigations, and for tax reviews for ages to come. And otherwise, we'll have nothing to do on this side of the table.
So let me ask you this, Ian. If we've got hundreds of employees, which I expect we need, if they're going to be implementing this incredibly complex body of rules that has yet to be defined, and keeping this unbelievable database together, will they be making the determination of whether or not there are malign actors that are visible from this information alone, or is that only going to be determined upon a request to FinCEN for information?
What I think is going to happen, look, again, the structure for the legislation was malign actors were using foreign accounts. They had, whatever the anecdotal or information they were relying on. But going forward, I doubt FinCEN's going to have the resources to go verify what say it's 2 million. Plus, if you change beneficial ownership going forward, you got to notify them of that. So that could be 3 million notices a year. And then in the first couple of years, people who haven't registered yet, if existing companies have to register, who knows? That could be another 10, 20 million account, corporate entities. So I doubt with, make up any number you want, 2 million, 5 million, 10 million reports they're going to get, that they're going to start verifying the information. So the only way you're going to find out whether this really is doing any good and was needed, and to the extent it was needed, was law enforcement getting access to the data, making the appropriate request with the appropriate protocols, once this is in place, and bringing criminal prosecutions. And it's going to take years to flesh out. Maybe it was needed. Maybe you're going to see all sorts of things you didn't see before. Maybe this will be a terrific tool for law enforcement, or maybe it's just going to be an enormous money pit, for the registry, and not much will come out of it other than work for lawyers such as myself.
Well, we've got these other, as you mentioned, potential $1 trillion revenue raisers, gap closing measures that the IRS commissioner has talked about, and others, and it's a focus on the Hill right now. Whether or not it actually goes through in a bipartisan package or not has yet to be seen. But regardless, you would think that this is a means of tapping that tax gap. And I'm curious to your thoughts as to whether or not Congress might ensure that the IRS is actively using this database to mine for tax gap closing measures and revenue.
Look, it may be it. Look, that's going to take a little time to flesh out. FinCEN's got to decide how they're going to permit access. That's not clear to anybody at this point. What is clear is, instead of making it automatic, like right now, in the tax series, if you file a foreign bank account report, an agent can look up whether the tax return matches the foreign bank account report for the year. The agent can determine if other information reporting forms, you can make up, numbers like 3520 and other things the agent could look at. That's all immediately available, on audit. None of this is going to be immediately available. They're going to have to make requests, whether they're going to make bulk requests, whether it's going to be to, again, purely for criminal, or whether they're going to define law enforcement include any civil regulatory agency as in theory enforcing the law like the IRS does. And so it won't be automatic, but it'll be easy or easier. Who knows? So it's going, you would think Congress wanted that. And I assume FinCEN will take that into account, because that's who's funding them. And drafting appropriate regulations about how tough or how easy it's going to be from agency like the IRS to use this information in the Treasury database. But yeah, it may be that you start seeing, there'll be in a year or two from now, you won't know, because till you get some statistics, the IRS could do bulk requests for, say, 100,000 names. What entities are in these individuals' names. And if you get that back, that'll be clear fodder for any audit. All you have to do is check the return. Was the return filed for, ABC Corp, supposedly owned by John Doe or Jane Doe? And if there's no tax return and there's no pass through, it's the first thing you ask on audit is, what happened to this entity? What happened to these three entities? And did you make anything? Where are the books and records? So it may well help. Look, this was one of a number of items which got into this bill. One of a number of items which is supposedly going to close the tax gap. One of a number of items like cryptocurrency regulation, which we're hearing about every day now, which also may close the tax gap and help finance, for instance, the infrastructure package, which is pending today as we speak. And it all remains to be seen. And this is a classic, what's the term? Stay tuned. We have to stay tuned. We'll see what the regs look like. Once we see the final the proposed regulations, by the end of the year, we'll have a better idea of how broad it is, how tough it's going to be to get information, how at least we'll have a sense of what the enforcement options will be, and we can all reconvene. And but again, I think this is going to be one of many. Any money laundering bill has enough sections in it, and this is again just one of them, that a lot of them are not only to stop money laundering and terrorism financing and malware. A lot of them will turn out to be fundraisers. I think you're absolutely right. And Congress wants them to be fundraisers. We won't discuss the deficit today, how big that number is and how big it's getting. But this is a way to in part close the tax gap, and whether they actually make reasonable statistics, good statistics about how much this is actually helping, we'll all have to follow up in the next year or two.
Well, I know we're getting close to time, but I got to ask you, come next January, how much of your treatise do you expect will be covering these new expansions that we expect to be learning on, these 48 questions that have yet to be answered, on all this uncertainty? I mean, it sounds like it could be quite a bit.
Yeah, this is not going to be good news. For those of you who are doing any writing out there, don't write a book. Write something. Write fiction. Don't write nonfiction. And there's something like this you have to update twice a year. Half of my primary money laundering chapter, which is almost 400 pages, single space, really tiny print too. I have trouble reading without glasses, and that's without the footnotes, which are embedded. Covers the Bank Secrecy Act, and again, this is the first time in 50 years they did anything. Half of this chapter, at a minimum, is going to end up getting rewritten, which is roughly 200 pages of single space material. I'm guessing, but I can't see what everything embedded in this legislation and everything FinCEN was tasked with doing, that they're not going to literally change half the money laundering world within the next year.
Well, I have a feeling a lot of people are going to be reading that expanded chapter, and it's going to be super important if folks want to avoid that malign actor characterization, that 2 to 5 year penalty, the felony, depending on what kind of violation you're looking at, and just the importance of this domestically and globally. And so, Ian, thank you so much for joining us today. It's been a fantastic discussion.
Thanks for having me, and we'll stay tuned at the end of the year.
For those of you watching and listening, thank you so much for joining Ian and myself today. Please don't hesitate to reach out to me. You can email me at ben.willis@taxanalyst.org, or you can find me on Twitter @WillisWeighsIn. Thank you.
Willis weighs in.